The Prescription for Disaster: How Rite Aid Cooked Its Books for $1.6 billion. Picture this. You're running one of America's largest pharmacy chains, but instead of healing your financial wounds with legitimate business practices, you decide to perform surgery on your accounting books with a rusty scalpel. That's exactly what happened at Rite Aid Corporation in the early 2000s, where executives didn't just fill prescriptions, they prescribed themselves fake profits to the tune of $1.6 billion. This wasn't your typical case of creative accounting or aggressive revenue recognition. This was a full-blown, systematic manipulation of financial statements that would make even the most hardened white-collar criminals blush. The scheme was so audacious and so pervasive that it infected nearly every aspect of the company's financial reporting, turning what should have been a trusted neighborhood pharmacy into one of the most spectacular accounting frauds in retail history. To understand how Rite Aid's executives managed to pull off this pharmaceutical heist, we need to examine the company's position in 2002. Rite Aid was struggling to compete against larger rivals like CVS and Walgreens, facing intense pressure from investors and creditors who were growing increasingly skeptical of the company's ability to generate consistent profits. The company operated over 3,400 stores across 28 states and the District of Columbia, making it the third largest pharmacy chain in America, but size didn't translate to profitability. Revenue was stagnant, costs were rising, and the company was drowning in debt from aggressive expansion efforts throughout the 1990s. Former CEO Martin Grass, who had taken over from his father Alex Grass, the company's founder, was determined to show Wall Street that Rite Aid could deliver the growth that investors demanded. But instead of fixing the underlying business problems, Grass and his team of executives decided to create an elaborate fiction that would temporarily satisfy shareholders while buying them time to turn the company around. Or so they thought. The accounting fraud at Rite Aid wasn't a simple case of overstating revenues or understating expenses. It was a sophisticated, multi-layered scheme that involved manipulating nearly every line item on the company's financial statements. The executives employed what they called vendor allowances, essentially rebates and promotional payments from suppliers, to artificially inflate the company's gross margins. Instead of recording these allowances when they were actually earned or received, Rite Aid would prematurely recognize them as income, sometimes booking millions of dollars in vendor allowances for deals that hadn't been completed or didn't even exist. The company would negotiate with suppliers for upfront payments in exchange for future commitments, then immediately recognize these payments as current period income rather than spreading them over the life of the contracts, as required by accounting principles. In some cases, Rite Aid executives would completely fabricate vendor allowance agreements, creating phantom income out of thin air and supporting these fictional transactions with forged documents and backdated contracts. But the vendor allowance manipulation was just the beginning of Rite Aid's accounting gymnastics. The company also engaged in widespread inventory fraud, deliberately miscounting merchandise to inflate reported inventory values and reduce cost of goods sold. During physical inventory counts, store employees were instructed to overcount products, particularly high-value items like cosmetics and over-the-counter medications, to create the appearance of higher inventory levels than actually existed. The company would also manipulate its inventory reserves, funds set aside to account for damaged, expired, or unsellable merchandise, by systematically understating these reserves to boost reported profits. When auditors questioned inventory discrepancies, Rite Aid executives would provide false explanations or doctored supporting documentation to cover their tracks. The inventory manipulation alone accounted for hundreds of millions of dollars in overstated profits over multiple reporting periods, helping the company meet Wall Street's earnings expectations quarter after quarter. The fraud extended into Rite Aid's treatment of capital expenditures and depreciation, areas that most investors and even some auditors often overlook. The company would improperly capitalize routine maintenance and repair expenses, treating them as long-term assets rather than current period expenses, which had the effect of reducing reported operating costs and inflating profits. Rite Aid would also manipulate depreciation schedules for store fixtures, computer equipment, and other assets, extending the useful lives of these assets beyond reasonable estimates to reduce annual depreciation expense. When stores were closed or assets were sold, the company would fail to properly write off the remaining book value, leaving phantom assets on the balance sheet that had no real value. The executives even manipulated lease accounting, treating what should have been operating leases as capital leases or vice versa, depending on which treatment would produce more favorable financial statement impacts. These seemingly technical accounting manipulations added up to massive distortions in the company's reported financial position. Perhaps the most brazen aspect of Rite Aid's fraud was how the company manipulated its relationship with suppliers and vendors to create artificial profits through circular transactions and sham deals. The company would enter into agreements with suppliers where Rite Aid would pay inflated prices for products in exchange for larger upfront rebates or allowances, creating the illusion of improved profitability while actually harming the company's cash flow. In some cases, Rite Aid would negotiate side agreements with suppliers that weren't properly disclosed in the company's financial statements, allowing executives to manipulate earnings by selectively recognizing favorable terms while ignoring unfavorable obligations. The company also engaged in round-trip transactions, essentially lending money to suppliers who would then pay it back in the form of vendor allowances that Rite Aid could recognize as income. These circular deals serve no legitimate business purpose other than to artificially inflate reported revenues and profits, but they allowed the company to show consistent quarter-over-quarter growth that impressed analysts and investors. The human cost of Rite Aid's fraud was staggering, involving dozens of employees at various levels of the organization who were either complicit in the scheme or pressured to participate by senior management. Chief Financial Officer Frank Bergonzi was a key architect of the fraud, working closely with CEO Martin Grass to develop and implement the various accounting manipulations. Vice Chairman Franklin Brown, who oversaw store operations, was instrumental in the inventory fraud, ensuring that physical counts were manipulated to support the company's inflated profit reports. Controller Michael Compton played a crucial role in executing the day-to-day accounting manipulations, preparing false journal entries and supporting documentation to hide the fraud from auditors. These executives didn't work in isolation. They recruited and coerced lower-level employees throughout the organization to participate in the scheme, creating a culture where financial manipulation was not only tolerated but explicitly encouraged by senior management. As with many accounting frauds, Rite Aid's scheme began to unravel when the manipulations became so extensive that they could no longer be sustained or concealed. By early 2002, the company's auditors at KPMG began asking increasingly pointed questions about vendor allowances and inventory valuations, forcing Rite Aid executives to create ever more elaborate explanations and fabricated supporting documents. The fraud had reached such proportions that maintaining it required constant attention and increasingly risky manipulations that raised red flags with regulators and investors. When new management took control of Rite Aid in 2003, they immediately launched an internal investigation that uncovered the full scope of the accounting fraud. The company was forced to restate its financial statements for multiple years, ultimately acknowledging that it had overstated profits by approximately $1.6 billion over a 6-year period from 1997 to 2003. The restatement revealed that instead of the consistent profitability that Rite Aid had reported, the company had actually been losing money in several of those years. The aftermath of Rite Aid's accounting fraud was swift and severe, demonstrating that even in the pre-Sarbanes-Oxley era, securities fraud carried serious consequences for corporate executives. Martin Grass was sentenced to 8 years in federal prison after pleading guilty to conspiracy to defraud investors and obstruct justice, while also agreeing to pay $3.2 million in restitution and forfeit assets, including his luxury home and yacht. Frank Bergonzi received a 28-month prison sentence and was ordered to pay $1.4 million in restitution, while Franklin Brown was sentenced to 10 years in prison for his role in orchestrating the inventory manipulation scheme. Several other executives and employees received prison sentences ranging from probation to several years, sending a clear message that corporate accounting fraud would be prosecuted to the fullest extent of the law. The Securities and Exchange Commission filed civil charges against multiple defendants, resulting in substantial monetary penalties and permanent bars from serving as officers or directors of public companies. The Rite Aid fraud stands as a cautionary tale about the dangers of prioritizing short-term stock performance over long-term business fundamentals, illustrating how quickly accounting manipulations can spiral out of control when corporate culture becomes corrupted by the pressure to meet earnings expectations. The case also highlighted significant weaknesses in the audit process, as KPMG failed to detect the fraud despite conducting annual audits throughout the period when the manipulations were occurring. Following the scandal, Rite Aid implemented comprehensive corporate governance reforms, including new internal controls, ethics training programs, and oversight mechanisms designed to prevent future accounting irregularities. The company's stock price, which had traded as high as $50 per share during the height of the fraud, collapsed to under $2 per share when the full extent of the manipulation was revealed, wiping out billions of dollars in shareholder value and demonstrating the ultimate futility of trying to create sustainable value through accounting gimmicks rather than operational improvements. Today, Rite Aid continues to operate as a much smaller company, having been forced to sell thousands of stores to competitors and file for bankruptcy protection in 2023, serving as a lasting reminder that in the world of corporate finance, there are no magic pills that can cure fundamental business problems. Only the hard work of building legitimate, profitable operations that can withstand the scrutiny of investors, regulators, and time itself.